The teacher stands in front of the class and writes on the board, "The mitochondria is the powerhouse of the cell." A student raises their hand and asks, "Cool, but what's a credit score?" The teacher smiles awkwardly. "We don't teach that here." And that's exactly the problem. School teaches you everything, except how money actually works. But we will. 1. Compound interest. Einstein joked it was the eighth wonder of the world. But Manuel Ayau would have called it the purest proof that markets reward patience. Compound interest is what happens when time and trust shake hands. When you invest, your money doesn't sleep. It works with others, funding ideas, factories, and innovation. Here's the math that built empires. $100 at 10% becomes $1,745 in 30 years, and $17,449 in 60. That's not magic. It's math multiplied by time. Warren Buffett built over 99% of his wealth after age 50, not by chasing trends, but by refusing to interrupt compounding. His mentor Benjamin Graham once said, "The real money is made in the waiting." Ayau saw compound interest as voluntary cooperation across generations. You're not just earning interest. You're renting your capital to someone who's producing value. Society grows because people trust others with their money. When governments promise get-rich-quick policies or artificially pump the economy, they interrupt this natural process. Ayau warned, "Prosperity can't be printed. It must be compounded. Time, not politics, is the ultimate investor. Miss it, and you'll always be sprinting. Respect it, and time itself becomes your business partner." 2. Opportunity cost. Every decision has two prices: what you pay and what you lose by choosing it. Ayau loved this concept because it exposes the invisible cost of bad decisions. Economists call it opportunity cost. He called it the unseen trade-off that shapes your destiny. Skip investing $5 a day for 30 years? You didn't just spend coffee money. You erased nearly $200,000 in potential compounding at 8% growth. That's the price of not choosing wisely. Even nations face this hidden debt. When governments pour billions into unproductive subsidies, they starve innovation. In the 1970s, Latin America, populist programs consumed budgets that could have funded schools or factories. The result? Inflation, stagnation, and missed prosperity. Steve Jobs understood opportunity cost intuitively. He left Atari to found Apple, trading comfort for creation, and turned that single decision into a trillion-dollar legacy. Ayau taught that real wealth isn't just about earning more. It's about allocating better. Money, time, and attention are scarce. Every yes is 1,000 silent no's. The difference between the rich and the poor isn't intelligence. It's awareness of alternatives. The wealthiest people see not only what they gain, but what they're giving up. And that same blindness, ignoring unseen costs, creates the monster we call inflation. 3. Inflation. Inflation isn't random. It's engineered. Ayau called it the most deceitful tax because it steals silently. In 1985, Guatemala's inflation hit 60%, erasing savings overnight. Argentina's hit 200% in 2023. People now buy groceries in dollars. Even the US, after printing trillions post-COVID, saw 9.1% inflation, the highest in 40 years. Why does this happen? Governments spend more than they earn and print the difference. That's not wealth creation. That's dilution. Your $1 becomes worth 90 cents, not because you failed, but because policy distorted value. Ayau warned that price signals, the language of markets, get scrambled when money loses honesty. When you can't trust prices, you can't plan production, trade, or investment. Inflation destroys the roadmap of the economy. The result? Workers chase higher wages, businesses raise prices, and savings crumble. The lesson is brutal but simple. Stable money is moral money. Anything else is legalized theft. 4. Time value of money. $1 today is worth more than $1 tomorrow, not because of math, but because it can act now. Ayau saw money as a living instrument. It only has value when moving through voluntary exchange. Think of this. If you had $1,000 in 1980 and left it under a mattress, it buys $340 worth of goods today. But if you'd invested that same $1,000 in the S&P 500, you'd have over $114,000. The difference isn't luck, it's movement. Ayau compared stagnant money to idle machinery, potential wasted. When governments freeze trade or distort markets, capital stops flowing and value evaporates. A productive economy is like a bloodstream. Circulation keeps it alive. The time value of money is a reminder. Value thrives on action. The earlier you put your money to work, the longer it collaborates with others to grow. Waiting too long isn't cautious, it's expensive. 5. Credit scores. Credit isn't about money. It's about trust quantified. Ayao believed that cooperation thrives only when promises are kept. Credit scores simply measure how well people do that. A score above 750 tells lenders this person honors commitments. That reputation opens doors. Better rates, faster approvals, cheaper insurance. But a bad score chains you to high interest and financial stress. In the US, the average credit card rate is over 22%. Brutal for anyone with poor credit. The 2008 financial crisis showed what happens when trust collapses. Lenders gave mortgages to unqualified buyers, ratings agencies lied, and the entire trust network imploded. $10 trillion in wealth vanished. Ayao saw that trust isn't built by regulation. It's earned by responsibility. A society's prosperity depends on millions of private agreements being honored daily. Your credit score is small proof of that larger truth. Economic freedom only works when people keep their word. 6. Good debt versus bad debt. Debt can be a tool or a trap. Depends on who's holding the handle. Productive debt creates value. Consumer debt kills it. When McDonald's borrowed to franchise in the 1960s, every new store repaid itself in months. But when millions swipe credit cards for short-term pleasure, they're mortgaging their future for fleeting dopamine. Ayao warned that societies collapse when debt funds consumption instead of creation. In 2024, Americans owed over $1.1 trillion on credit cards, with average interest rates topping 22%, the highest in history. That's not growth, that's financial gravity. Meanwhile, the same system rewards productive borrowing. Elon Musk financed Tesla's expansion with debt, backed by future profits. Even countries do it right. Singapore borrowed strategically in the 1980s to fund housing and infrastructure, turning every borrowed dollar into productivity. Debt, Ayao said, is like fire. It can cook your meal or burn your house down. The secret is simple. If it doesn't earn, it burns. And here's the twist. This same principle shaped how ordinary people became extraordinary owners. 7. Investing basics. Here's the uncomfortable truth. Workers survive, owners thrive. Ayao called ownership the moral backbone of capitalism, because when you own something, you're part of creation itself. In 1980, Apple went public at $22 a share. Today, adjusted for splits, that same share is worth over $200,000. Not because of luck, but because Apple kept producing value and owners shared the reward. Only 58% of Americans own stocks, while the wealthiest 10% hold over 90% of total equity value. That imbalance isn't accidental. It's the difference between participating and spectating. In South Korea, post-war reforms encouraged citizens to buy shares in rebuilding industries. By the 1990s, ordinary Koreans owned massive stakes in companies like Samsung and Hyundai, proof that capitalism works best when everyone has skin in the game. Ayao believed investing was cooperation in its purest form. Millions voluntarily pooling trust to create progress. Buying a share of a company is like voting for its mission, not with words, but with belief. And the system that keeps those votes valuable? It depends on something far more fragile than cash. Trust itself. 8. Currency and trust. Money's power isn't in ink or metal. It's in belief. When that belief cracks, the whole economy shatters. In 1923 Germany, hyperinflation hit so hard that prices doubled every 3.7 days. Families carried wages in wheelbarrows. Kids made kites out of banknotes. A loaf of bread cost 200 billion marks. Venezuela's bolivar met the same fate in 2018. Inflation soared 1 million%. Ayao called this the moral collapse of money. He argued that stable currency is moral currency, because honest money protects the poor most. The wealthy can hedge inflation, the poor cannot. When governments print for political gain, they commit silent theft. Guatemala's 1980s inflation crisis inspired Ayao's crusade for monetary stability. He pushed for rules limiting money supply growth, insisting that currency must be trustworthy before it can be useful. The US dollar dominates not by force, but by credibility. Trust, once lost, takes generations to rebuild. Money isn't paper, it's a promise. Break the promise and everything else falls apart. And when that promise breaks, governments look for another lever: taxes. 9. Taxes. Taxes are civilization's rent, but charge too much, and tenants move out. France learned that in 2012 when it imposed a 75% super tax on millionaires. Within 2 years, 42,000 wealthy citizens left. French actor Gérard Depardieu fled to Belgium. Businesses followed. Instead of collecting more, France collected less. Ayau said high taxes punish productivity and reward escape. When Reagan cut U.S. top tax rates from 70% to 28% in the 1980s, government revenue didn't fall. It rose by 25% within 5 years. Growth, not punishment, filled the coffers. Ireland and the Netherlands became corporate magnets with friendly tax systems. Apple, Google, and Netflix moved operations there, creating jobs, not just profits. That's the paradox. Lower taxes can expand the pie. Ayau's view was clear. A fair tax system supports creation. An oppressive one kills it. Every dollar taken from a builder is one less bridge, business, or innovation for society. But when governments run out of tax options, something bigger always follows: an economic reset. 10. Recessions. Every boom whispers the same lie. This time is different, but it never is. In 1929, the Dow fell 89% in just 3 years. The 2008 housing crash erased $10 trillion in global wealth. Yet from each collapse came rebirth. Microsoft was born after the 1973 recession. Airbnb and Uber emerged from 2008. Ayau saw recessions as moral corrections, moments when markets shed their lies. Cheap money, inflated prices, reckless speculation all meet gravity. He called it the cleansing of error. Recessions hurt, jobs vanish, prices swing, optimism fades. But without resets, bubbles grow until they consume everything. That's why 2008 wasn't an end. It was a restart button for an economy that forgot how to price risk. Ayau's lesson? Don't fear the reset. Prepare for it, because after every storm, assets reprice, innovation surges, and builders take the stage again. Recessions don't destroy capitalism. They remind them of what honesty feels like. Thanks for watching. Seriously, you're part of a rare group that actually wants to understand money, not just chase it. If you enjoyed this, subscribe for more deep, story-driven lessons like this one. The next episode connects everything you've just learned.